Welcome back to Open House with Mark Siwiec and Corey James Moran, brought to you by Elysian Homes by Mark Siwiec and Associates, a greater Rochester real estate podcast. This is episode 160, and it's a big one this week, Mark.
It's a big one.
It's the one we've been waiting for.
It's the one that everybody has been talking about for... Yeah,
Ever?
and everybody's been saying the exact same thing. Well, we knew it was coming, but was it a quarter point or was it going to be half a point?
Yes.
Let's hope that you and I can provide something other than that in terms of our desire to elucidate what it actually played out yesterday.
Ooh, good word.
You like that word?
It's a good one.
Okay, good. All right.
Yes, we will chat about the big rate cut that finally happened.
Finally?
Although the thing that happened after the big rate cut.
We'll get into that in a little bit. What else we got?
Let's see. What does this all mean moving forward?
Okay.
And that's the big question, really.
Yes,
That's what really matters the most. But first off, how are you this week? Doing well?
I'm good. I'm doing well. Yeah, another beautiful day.
It's summer
Just
again.
one after another. It's just so beautiful. It's just great.
I just got back from lunch with my wife. We went out to a New York kitchen in Canandaigua.
Oh, that's
sat
great.
outside with the new baby.
I was going to say, was it
Guess
just
what?
the
He
two of you?
slept.
Oh my God.
I know, you're shocked.
He is a sleeper.
Yes.
You're so fortunate. Yeah. Actually, it was last Wednesday after we recorded this that you and Court and Jax came over to the house for a little shower.
That's
Yeah.
right.
So
yeah.
yeah.
Well, not to bathe, but yes, baby shower
Yes.
along with
Yes.
Aaron Duffy Cruz
Yes.
from the
Yep.
team who...
Yep. I mean, Annie,
Soon?
for her sake.
I hope so.
Oh, dear God.
By the time, you know what? I'm going to throw it out there. Prediction. By the time this podcast airs and is out there,
Okay.
she'll have had her baby.
Well, today is her due date.
Fingers crossed.
So, yeah.
There we go. All right. Thank you so much for listening. If you're listening like you normally would, or if you're watching, I've been getting a lot of people watching the videos, which is really cool. We appreciate that.
It is. Yeah, I started to get some nice feedback about that. Yeah.
There we go. Well, excellent. Well, we want to dive in?
Let's do it.
Let's get the market update. So, kind of interesting here. Last week, in terms of new listings, single-family active listings, Monroe County, decent boost. I know. Are you shocked?
A little bit. Yeah, go ahead.
All right, 498 last week. We're up to 547 this week.
That's actually very interesting.
That's
really.
That's I think
Wow.
the biggest jump of the year so far.
That's a 10% jump. That's amazing.
6 county region, 896 last week. Currently 948.
Wow.
So good numbers there. And then what's even more interesting is that we've been seeing a trend where, maybe there's a little bit more in terms of active listings, but the pending and under contract properties, that number's going down. That number also rising.
Wow.
1120 for Monroe County last week. We're at 1133 right now.
So this maybe is now is maybe not the time, but I keep trying to understand and trying to figure out what's going on. Have the buyers disappeared, or do the buyers simply have more options?
Could be a little bit of both.
I think it might be.
I mean, there's definitely a lot of buyers out there that are not following the advice we had from last podcast, waiting for this rate cut to happen.
Yes, that very much the case.
Because again, they were expecting, all right, big rate cut comes, mortgage interest rates, they're going to drop, right?
Right. Yep.
And again, we'll get to that in a second, but that's not quite what happened. 6 county region, though, in terms of under contract pending properties, 1722 last week. We're at 1749 right now.
Okay. Very good. Interesting.
Yeah.
Wow.
And then I mentioned those mortgage interest rates. So we have seen them tick down a little bit. Last week we were at 6.22, at least when we recorded the podcast. They did drop lower. The lowest was 6.12, I think that I saw.
6.11.
Okay.
Yeah.
They're now up 6.17% for the 30-year.
Yeah.
And then for the 15-year, we're at 5.65%.
Okay. I was thinking earlier today, it wasn't that long ago when you and I were celebrating. Do you remember? We were so excited to finally get a 6 handle.
Yeah.
We were so excited. And that wasn't that long ago. And there's been really a remarkable drop from 7.3% down to 6.15% and 6.17%. So that's quite a drop.
And hopefully, not the end. Hopefully there's more drop to be had.
There's more to be enjoyed, yes.
Before that, though, Mark, do you want to talk about our friends at Elevate?
Oh, sure. Oh, my God. I mean, what is there to say? It's the best gym in town. It's just opened. And sure enough, Nick Mancuso, who is just such a great guy, he was predicting that he was going to have a slow start in the summer. He wanted to work out all the bugs, all the kinks.
Sure.
And he said once Labor Day hit, and the place is just flooded. It is the nicest gym, best trainers in town, best equipment. You got that plunge pool. You got the infrared sauna. Go check it out.
There we go. All right. So the big story.
Yes, let's do it.
The rate cut. It happened.
Yes.
The Fed announced not a 25 basis point cut, but a 50 basis point cut, which
Hair
is
on fire.
what we were hoping for, right?
Yes. But in this climate in which that which is seemingly good is bad, and vice versa.
Rates actually ended up going up, like we said.
Yeah.
So I still think there was a lot of...
When you say rates, the 30-year mortgage went up, yes.
Right.
Yes, the federal fund rate was cut. The 30-year mortgage rate actually increased.
Let's dig into why. Why did that happen? Because again, there's a lot of people that are a little confused about this. In many people's minds, it's, all right, well, they announced a rate cut, so now, we're going to see a gigantic rate drop for mortgage interest rates.
So the federal fund rate does not actually impact the 30-year mortgage. It's the 10-year treasury that impacts the 30-year mortgage. And the 10-year treasury is constantly looking into the future to determine what is coming down the pike economically. And so over the course of the past few weeks, we knew there was going to be a rate cut, which is ultimately going to create a stronger economic environment because more businesses are going to be able to borrow money, hire people, create product, et cetera, et cetera. So over the course of the past 6 weeks, in anticipation of this, interest rates have gone down. The mortgage rate has gone down from 7.3% down to 6.17% or 6.11 a few days ago. But now, as a result of Chairman Powell's press conference, people are running around saying, okay, oh my God, it's a half point, not a quarter of a point. Maybe he knows something that's going on with the economy and perhaps we're heading into a recession. So the 10-year treasury, looking into the future, as they often do, as they always do, they're wondering, oh my God, is this actually bad economic news? And that's why it is that the 10-year treasury has actually risen over the course of the past few days.
Isn't it kind of crazy that for something that's so important and plays such a key factor from a monetary aspect in the majority of our lives, it can be moved so much by pure speculation and simply just shooting in the dark and guessing what someone means? Well, I mean, do you want to go over what Powell said and really?
That would be great. Yes.
All right. So,
but this is always. I mean, we've talked about the parallels that exist between this and and the Kremlinologists who used to try and decipher what it is that Gorbachev would say back in say the 60s. Yeah.
What does he really mean?
Yes,
what does
exactly.
he really say?
They would always look to see like which members of the apparatchik would actually, where would they be sitting? And somebody was in row 1, 3 months ago. Now they're in row 6. Oh my God, they're on their way out. And sure enough, they'd be assassinated days later. Yeah. Anyway, so what did Powell say?
All right. So one of the good things is that he did not show a visible concern over the labor market, which we've got some numbers there. The jobless claims we'll talk about later in the podcast. Not shocking there. He was clear to specify that a 50 basis point cut is not going to be the norm going forward. Mm-hmm. So it could be really anything, although they did signal that another cut could be coming before the end of this year.
Right.
And then they outlined several more cuts for 2025. We could actually see 2 full % down from where we were by the end of next year, by the end of 2025. He stayed well clear of declaring victory over inflation. Did not say that. But did you expect him to?
Yes.
You did really?
Because the CPI came in at 2.5%. The target rate is 2%. And there is a lag. So when we're probably, every journal article that I've read, every economist that is speaking, I think they all say that we've vanquished inflation and that the concern now is recession. The concern now, actually more precisely, the concern now is the labor market. So I do think that he's being a little overly cautious there.
Can you really blame him? We've sat here in these chairs and other chairs in the area recording these podcasts for the past 2+ years, and we have had the carpet pulled out from under us how many times? Do you think Powell wants to say we did it?
Well, he did back. Remember, he did back in December.
Well, there you go.
Yeah, and he got way ahead of his skis. But nevertheless, I mean, I think it's disingenuous for him to say that we have not vanquished inflation when the CPI comes in at 2.5%. So.
We'll see again, but I think also one of the points that we brought up quite a bit has been the political climate that we're in with the election. Right. I think he's also probably tiptoeing a little bit because of that. Maybe not an election year. Maybe he actually does be a little bit more aggressive in that stance, but because it is, and he knew the pushback he was going to get, we were just saying that because of the election. I mean, there's a lot going on.
Oh, yeah. So, but square this, because I know you had another bullet point there, but I think I know one of those bullet points. So he's saying on the one hand that we have not vanquished inflation.
He didn't say that we have not vanquished it. He didn't come out directly and say we have done it.
Okay, but then he also, what's your next bullet point?
He reiterated that the, quote, neutral rate is probably significantly higher than before the pandemic. So
Okay,
this magical number of 2%, right?
This magical number of 2%. So wait, so if we haven't quite vanquished inflation at 2.5%, and the neutral rate, which was 2.2%, is now actually probably a number above that. Well, how much distance exists between 2.5% and 2%? So anyway, again, I think he's being disingenuous. I'm still a big fan. I think he's done an incredible job. We're experiencing the soft landing that everybody had hoped for, and I think he's great. I just think this is just a little,
A little too much show.
A little bit of hogwash. Yeah.
So, but again, I think one of the really important things in terms of why rates have maybe jumped up a little bit is because of it's been an aggressive drop down from where we were.
It has been aggressive, but at the same time, I think it's right. Well, we also, I've got to do a little bit of research on the spread, because I think the spread has also come down. And the spread, just as a reminder for those who don't recall or remember what the spread is the difference between what it is that the federal government will loan to a bank, and then what it is that the bank will then loan as a mortgage to a consumer looking to purchase a property. So that spread is traditionally about 1.75%. And in the past couple of years, the spread has actually been closer to 2.5% to 3.5%. So quite a bit, quite a jump there. So, but the spread over the course of the past month or so has actually started to come down pretty significantly. So I think that's also been playing into it.
For sure. I think one thing we can all agree on, though, is that this is all still good news. This is better than pretty much any other possible way this could have gone.
Absolutely. And we may not enjoy, no, we have enjoyed it. I was going to say we may not be enjoying the benefits today. We actually are enjoying the benefits today. They've just been handed to us over the course of the past 6 weeks. So, right. and I did just hear a point from a few moments ago. There are 2 more meetings at the FOMC, one in November and another again in December. So there's a very strong possibility of another quarter point percent lowering in November, another quarter point in December. So I think we're on the road.
Well, they've kind of laid that out. Is it the dot plot? Do you want to talk about the dot plot?
Sure. What do you want to say about that? Do you want to explain what the dot plot is?
Yeah.
Okay, so
other than a really cool name.
Oh yeah, it is a great.
It's a fun name for a video game from the 1980s.
Yeah, exactly. So all the members of the Federal Reserve, there are about 20 of them or thereabouts. They all create a plot, a graph of where it is that they think that interest rates are going to be headed, or more specifically, the federal funds rate is going to be headed over the course of the next several years. And they do it quarterly to determine where it is. So I haven't actually read anything about where it is. I've got some speculation, but I would venture to guess that the aggregate or the average of the dot plot on the part of the Federal Reserve members shows the federal fund rate bringing the mortgage rate down to what, 5.5%, something like that next year.
Fingers crossed. Yeah, I haven't seen. Yeah,
you haven't seen anything. Okay, so you just want So the dot plot was issued. They issue that a couple times a year. So I've got to do a little bit of research on that. I mean, the reality is, but. And getting a little off topic, I haven't schooled up on everything that took place yesterday because, again, I'm just like, my days are ending at like 9:45, 10:15 at night, and there's just so much work to be done in terms of the buyers and the sellers who are coming our way that the reading that I love to do and the research that I love to do, it's just been absent from my life in the past 24 hours.
It's okay. It's a good problem to have.
Okay, yeah, it is a great problem to have. I just wish we were a little more precise in terms of what's going on.
Well, listen, we've got another.
But I sound okay.
We've got months and months of talking about this.
Oh, there we go. True.
We're about to enter the slow season. We have a lot of time to talk about this. Don't worry.
True. Yeah.
So, is this the break buyers have been waiting for?
That's the big question. I mean, as of right now, as we're sitting here, I think the answer is no, because
or not yet. I think the answer is not yet.
That's thank you for correcting me, because that is correct. I think that indeed after the first of the year, buyers are going to come flooding back into the market. But perversely, we're thinking that we're going to be overrun with buyers re-entering the market over the course of the past 2 weeks, and that hasn't played out. The listings that we've been putting on the market for sale, 8 last week, 7 this week, they're mostly selling, but they're selling as a result of 3 or 4 showings, and then an open house with 6 or 8 people attending, and then the property selling a day or two later with 1 or 2 offers. And so there's just all that urgency and all that exuberance has just been let out of the balloon.
So, piggyback on that.
Yeah.
What does this mean for sellers?
Yeah.
In the immediate and then also in the future.
I can't even forecast the future because, again, as we've said a few times, Rochester is going to see this enormous influx of new listings coming in the market for sale after the first of the year. But we're also going to see an enormous number of new buyers coming into the market as a result of the mortgage dropping down. So I can't even begin to forecast what's going to happen after the first of the year. But in the immediate future, I think we'll have a much better sense over the course of the next 5 to 7 days whether or not buyers have really purposely been just waiting for Jerome Powell's message to the nation yesterday, and whether or not they've come flooding back into the market as a result of that, or whether or not they're just looking at it and saying, yeah, well, that's really great. Let me get through the presidential election.
Sure.
Let's make sure that nobody's burning down the Capitol, and then I'll begin after January 1st my quest to purchase my new home.
It's interesting because all of this is aligning with something that we said on the podcast last week, that now could potentially be the best time to buy for a buyer. And
what a great segue.
And there was also an article on Realtor.com that gave the dates.
Where'd you get that article?
Alex, our buddy, reached out.
Our engineer.
Not just an amazing editor, but also...
Not an amazing editor, not just an amazing editor.
Full producer now.
Not just a great producer, but a great social media. This guy does it all. So we're so great. Thank you, Alex. Thanks, Alex Brennan. We're thrilled. So.
But they're saying the best time to buy...
Gold star?
Yes.
We need a gold star.
5 gold stars.
Yeah,
we get gold,
got like
5 gold stars? Okay.
Yeah, he's going to have to post that next week. Yeah.
Best time to buy this year, they're saying...
In Rochester, they're saying, yep.
September 29th through October 5th.
And today is September 19th.
Coming up on it. You got time still.
10 days. We got 10 days. So we got to get this thing published and get people prepped and ready.
So this article said that buyers can expect to actually save $14,000 compared to the peak summertime.
Okay. That sounds like that's a lot of money. That sounds a little aggressive. Actually, you know what? In light of what's played out over the course of the past week and a half, and what it is that I'm seeing our listings selling for, the price above asking, that number probably isn't far off.
You think?
Because these properties are not selling $50,000, $65,000, $85,000 over asking in the way that they were. They are selling over asking, but not in these large chunks of money in the way that they were. So,
well, can you combine that, and then we talked about it earlier with the market update. We're seeing a bit of an increase in listings.
Yes.
It's all kind of coming together.
Yeah.
So now is when all the buyers are going to come running back to the market after we said that. Obviously, it's going to be our fault.
Hey, let's hope.
One of the big things that I keep seeing too in terms of this rate cut, refinancing. They're saying a refinancing boom is on its way.
Two things. One, I just met with our friends over at Genesee Regional Bank, and they said that they have been inundated with calls from clients who are looking to refinance. And I personally, because of the rental properties that I've got, I looked at the roster of rental properties, and I was shocked. And I knew in the back of my mind that I needed to refinance, but there are 3 or 4 of them that I purchased with adjustable rate mortgages when those adjustable rate mortgages were at like 2.85%.
Sure.
And now they're at like 7.9%, like just ridiculous. So I've got to refinance sometime in the next few months, and I've got to lock in a 10-year amortization or something at a much lower interest rate.
Right. Well, we talked about it, was it last week or the week before, about when to refinance, what that number should be.
Yes.
And again, we're hearing all this talk about the refinancing boom, and a lot of people are going to jump the gun, in my opinion, and do it now. But again, we still think there's more to drop. We think the rates are going to go lower.
Oh yeah, absolutely.
Again, 5.5 is my number. At 5.5, if you want to make that leap, go for it. Until then, I think.
When do we get to 5.5?
End of next year.
End of?
Middle of next year? You think it could be middle of next year?
Yep, June 1.
Okay.
Yeah.
Is that what's in your planner?
Yeah, I've got it.
Refinance properties,
yeah.
June 1.
Yeah, I've got it on the wall, the big calendar, circled, yeah.
So the big Fed rate cut wasn't the only big piece of economic news that we had over the course of this week. There was a few other things we can just touch on really briefly. The retail sales report came back.
Yep.
And that was just a slight increase, 0.1% in August, which actually showed a market slowdown because there was a 1.1% rise in July. And really, this is just showing some consumer caution. These numbers are signaling a bit of a slowdown as consumers are a little more cautious. These recession fears, we feel like Jerome Powell got the soft landing. We're not going to go into a recession, but there's still a lot of people that are concerned about it and economic stability.
But when you really start to drill down, it's the haves and have-nots.
Sure, yeah.
Anybody who is a middle-class American, they are starting to tighten their belt. They're starting to run up some credit card debt. They've blown through the savings that they enjoyed during COVID, and they're now just starting to pull back a little bit. And you're even starting to see some fast food chains who are actually starting to reduce the prices.
A lot of $5 meal deals.
Yes, exactly. Yes. So they're starting to reduce the prices because of this phenomenon playing out. The flip side of that coin is that you get those who are wealthier Americans who are still just taking to the sky and flying overseas and not just staying at the local, the equivalent of Germany's Holiday Inn or Red Roof Inn. They're staying at five-star resorts. And so that segment of the economy, that demographic is still doing very, very, very well.
It's kind of interesting just the sectors and how they performed. Healthcare, personal care, sporting goods all saw growth, while motor vehicles and general merchandise experienced declines.
Okay. Speaking of motor vehicles, wasn't that thing ridiculous?
Okay. It's really quick aside. I saw the first Cybertruck in person. Awful.
Dude. I mean,
it was the ugliest car I've ever seen.
And the great disappointment was the guy got into the car and drove off before we got a chance to see what tool would actually purchase such a thing and then get in and drive off. And there was some speculation that as we were this is terrible. But as we're trash talking this car, there's some speculation that he was actually sitting at the table next to us.
Sorry, not sorry.
Yeah.
It's ugly. Yeah. Everyone knows it. Why would you buy that?
Yeah. Anyway, all right, go on. Other economic news released this past week. What
jobless claims. So we talked about the labor market, how Jerome Powell said he didn't really have concerns about it. It's performing well still. Initial jobless claims for unemployment benefits dropped to 204,000 for the week ending on the 14th. Okay,
there we go.
Down from the revised 221,000 the previous week. Yeah. And it's lower than the economists' expectations, which had projected claims to be around 215,000. Okay. So again, that number is down. The labor market, again, has been one of those things that's been kind of confusing because it's been so hot and so strong.
Yep. And textbook economics tells you that you cannot you cannot conquer inflation unless it's at the expense of jobs. And while the unemployment rate has gone up, it's still a great rate. I mean, 4.3%, 4.4%. That's a great rate. So again, as we've said any number of times, textbooks will be written, journal articles will be written in days spent in college economic classes about what's been playing out these past few years.
And as we're speculating on Powell's comments in the press conference, the labor market could be the one thing holding him back from saying, we did it.
Right.
We vanquished inflation.
Yeah.
The final thing was home builder confidence.
That or Marjorie Taylor Greene. But anyway, go ahead.
According to the National Association of Home Builders for September of 24, confidence rose to 41, up 2 points from August. This marks the first increase in 4 months, breaking a streak of consecutive decline. So builder confidence is up.
That's great.
Despite that positive outlook, high construction costs remain a concern, obviously, on continuing to limit enthusiasm amongst builders. Additionally, rising competition for existing home inventory poses a challenge as mortgage rates start to drop.
Okay, there we go.
Listener question?
Yeah. What do we have this week?
Yeah,
anything interesting?
So we got a really good one here. If you would have any questions about the real estate market, anything we talk about, if we talk about something on the podcast, you're like, I don't know what that is. You can reach out to us. Happy to elaborate further on it. This is from Sandy.
Okay.
And Sandy says on your last...
My mother?
No, not your... Other Sandy.
Okay, got it.
On your last podcast, you briefly mentioned appraisal gap coverage. Can you guys explain that in more detail? I was also wondering, how many banks should I get a pre-approval from? And is a local bank better than a national bank?
Wow, okay.
So a little three-parter here?
Yeah, three-part. A lot to unpack. So do you want to start?
Yeah, so appraisal gap coverage. Okay, so when you're getting financing for a property, the bank is giving you a lot of money.
Yep.
And they want to make sure that the property you're buying is worth enough that if you were to default on that loan, they could take it, sell it, and make their money back.
Yes.
So that's why throughout the process of a real estate transaction, you get your offer accepted. A couple weeks later, an appraiser walks through the property to give that valuation. Let's say you bought the property for $200,000. You get it accepted, you're ecstatic, you're on top of the world. It's the 14th offer you put in, you finally prevailed, everything's great. Until 2 weeks later, an appraiser walks through and says, yeah, that property's worth $175,000. There's now a $25,000 gap, an appraisal gap, that needs to be taken care of in some way, shape, or form.
And if it's not taken care of, the deal could fall apart.
Right. So really there's a few things that could happen. In a magical unicorn world where fairies rule, you could renegotiate with the seller to try to get them to come down, because you would just say, well, the appraiser said that it's worth $175. I know I wrote in a contract, I'm willing to pay $200 for it, but the appraiser says this, so you're willing to come down $25,000, right?
Yep.
Never happening ever. Not in this market anyways.
Yes.
So there's that. Maybe there's a meeting in the middle, still very unlikely. What's going to happen most likely is that the seller is going to go to whoever came in second when offers were brought in and just go with them.
But appraisal gap coverage is hardly ever invoked. Would you agree? I mean, because most of the time, properties are appraising up for what it is they need. Do you agree with that?
The majority of the time, every now and again, there's a few instances where unfortunately it does become a thing. So it's something to be aware of. And certainly, if you're able to get an idea of what that number is going to be prior to putting that offer in, that's going to help you out quite a bit. Something also to think about in terms of an appraisal gap. So a lot of people think that no matter what you're putting down for your down payment, that when you get the appraisal, it needs to be the same value you're purchasing the property for. When in reality, the appraisal has to come in at 5% above the purchase price. So if you're putting down 5%, it needs to come in essentially at value. If you're putting down more, you're putting down 20% like many people do, you actually have more wiggle room to avoid getting hit with that appraisal gap.
Yes, exactly. Because the bank's loan is safe. If the bank needs to foreclose, they're foreclosing on a property they will then be able to turn around and sell without losing anything. So.
Right. So a little bit more on appraisal gap as just a tactic to make your offer stronger. A lot of buyers will write in there that we're covering $10,000 if this were to happen, we're covering $15,000, or we're going to cover 100% no matter what that number is.
Okay.
So that's a way to make yourself a little bit more aggressive and it's a stronger offer if you're a conventional loan versus a bunch of these cash offers.
There we go.
All right. Did I miss anything?
Great. I was going to say, great explanation.
Nailed it?
Yeah, fantastic.
All right. That was part one of the part three. The second part, how many pre-approvals should you get?
What's the third question? Because I might be able to tie the two of them together.
Is it better to get a pre-approval from a local bank versus a national bank?
Okay. So in answer to the second question, it's tied to the third question. There are really only 2 or 3 lending institutions here in Rochester that agents and their sellers are willing to work with. And the sad reality is that agents have found through their experience that any of the big box banks, Chase, let's go with HSBC, M&T, they're terrible to work with because your buyer's mortgage application is one of thousands and thousands and thousands that they're having to process, and they don't really care whether or not you're 3 weeks late in terms of securing your mortgage commitment. And that's oftentimes what happens. So real estate agents locally are constantly coaching their sellers to work with one of these local lending institutions. Genesee Regional Bank and Premium Mortgage are the two that people really turn to locally and say, you know what, we think these are both safe lending institutions. We never have a problem with them. So that's the answer to this third question, but it ties to the second question because you can go and get 2, 3, 4, 5. You can go and get 3, 4, 5 different pre-approvals. But really, nobody is going to be looking at, the sellers aren't going to be looking at the majority of them because, again, they are geared to look at only 1 or 2 local banks. Do you agree with that?
I would, yeah. I mean, I think from the standpoint of doing your due diligence and deciding who you want to work with, like we talk about all the time, interview multiple agents, interview multiple lenders, and see what the best fit is. One little caveat to that you really want to be careful of, if you are getting multiple pre-approvals, you want to talk to that lender and you ask them this question: if you're going to pull my credit, is it a hard pull or a soft pull?
Yeah.
Because if it's a hard pull, that can negatively impact your credit score, which could actually negatively impact your ability to get that loan.
Absolutely, and I agree with that. Let me go back to my example. So let's say that somebody gets an approval from GRB, or pre-approval from GRB, and a pre-approval from Premium. There's really no reason then to go to M&T, to HSBC, to KeyBank, because nobody locally is going to be looking at those two things. So really, it's just go to two different. And then actually, one of the things that I love, I think this is a key point. One of the things that I love is when it is that we're telling our buyers that if they're getting a quoted the rate of, let's say, 7.5% at Bank A and Bank B is coming in at 7.4%, go back to Bank A and say, listen, Bank B is offering me 7.4%. Can you beat it? Play them off each other.
That's what my dad loves to do to car dealers. It's literally his favorite thing in the entire world.
There you go.
He will walk in there and he will say, well, this is what they offered over across the street. And well, I don't know how they did. We can't do that. And he'll just get up and start walking away. And then he'll well, wait a second. Let me see what I can do.
God.
And then he gets to march back into town.
I'm a car salesman. So glad.
So yeah, great question from Sandy.
I think we answered all of Sandy's questions.
There you go. All three. 1 for 3. Look at that.
Yes.
Anything else before we jump into celebrity real estate?
Let me open up my my iPad here. Let me see what we got going on in terms of celebrity real estate.
I mean, listen, I don't want to take credit for this. Okay, I'll take a little bit of credit for this. There's a property that we talked about for celebrity real estate last week on the podcast that had literally been on the market for 12 years.
There we go.
Michael Jordan's house in Highland Park, Chicago. It was originally listed for $29 million back in 2012. He had dropped that price to $14.855 back in 2015. It's a 56,000 square foot mansion that features 9 bedrooms, 19 bathrooms, a basketball court, a putting green, and a lot of custom MJ themed details.
Yeah, I bet.
That just sat forever. Someone bought it.
Yeah. Well,
we mentioned it once in the podcast, and now it's sold.
Clearly,
I mean, obviously,
he's indebted. He's clearly.
Next time
indebted.
he's in Oak Hill, I'll be sure to reach out.
There we go. That guy is an icon. Oh my God, I love Michael Jordan. He is such an inspiration. But if you can have the ability to hold on to a home valued at $27 million or $15 million, $12 million, whatever it might be, and not even live there, that's
true. Yeah, it's big money.
That's pretty serious money. But when you're worth, I think I looked it up last week. Isn't he worth like $3.5 billion or something?
Crazy? Yeah, I mean, so obviously,
so yeah, good for him.
Less the money, it was more the fact that it was a really long time. And I think there's actually a great lesson to be learned for all sellers from this. That if your home is too personalized to you, that can really negatively affect you.
Absolutely. I always talk about the house, and I've mentioned this before, the house in Pittsford, in which he was a train enthusiast, and he had cut a hole and created like an arch in every room of the house, so that in the ceiling there was a track hanging from the ceiling, and this train would run from room to room to room to room through the arches that were cut between rooms in every room of the house. And it sat there for 3 years.
Yeah, because that's really cool for him. But if you don't give a crap about trains, it's
or if you
how do I fix those holes?
Want a little bit of privacy between multiple bedrooms in the house. Yeah. So anyway, all right. Let's go to the second one here. What do you got for me?
Boxer, well, retired boxer now, anyways.
Okay.
Floyd Money Mayweather has listed his Beverly Hills mansion for $48 million, almost double what he paid for it.
Bud, when did he pay?
So he bought it for $25.5 million back in 2017.
So that's not a long time.
Not a bad investment for this.
But we are clearly in the wrong line of work.
Yeah, we should have been boxers.
I should become a boxer or a basketball player or a movie star.
Yeah.
Like anybody in the entertainment, like they do well.
Well, with the athletic gifts that we've been graced with, it's shocking that that's not the line of work that we've gone into.
You see me jump shot. You see my jump shot. Like, wow.
So his property that now is listed for double what he paid for it. It's a 15,000 square foot home in Beverly Hills, 6 bedrooms, 9.5 bathrooms.
Wow.
I mean, the amenities in this thing are absolutely insane.
Only 9.5 bathrooms, you said?
I know, right? MJ had 19. That's right.
Yeah. My God. Okay, nice house.
Just nice.
Nice house.
Not your cup of tea?
Yeah.
I feel like you hate the athletes'
Oh,
houses.
come on. You did not. I just opened the third.
We're going there.
Oh man, you're brutal.
I mean, we got to talk about it.
Well, all right, okay. So I haven't been following it. It just I honestly I can't read the news articles. I don't want to know.
Yeah.
Yeah,
It's some gruesome stuff.
It's pretty. All right, so go ahead. What are we talking about here?
Sean Diddy Combs, the rated LA mansion, remains on the market, shocking, for $61.5 million as he's been arrested for sex trafficking charges.
Crazy.
Who would have thought? I mean, what a wild turn.
Do you think? I'm looking at this outdoor photo.
Yeah.
Do you think that, given that he's going to be spending a lot of time in jail, do you think he might sell this table to me?
He might.
Because I really like this table.
Possibly.
That's a nice table. That's a really good table. It would look good in my backyard.
It's going to collect call to the jail and ask him real quick. He actually tried to
wait, come on. Are you looking? Did you see the exterior of the photo of the house? Mm-hmm. Did you see the sculpture or whatever the hell it is on the left side of the house?
Oh, I point that out. Alex, put this in the podcast. What do you think?
Okay, it's somebody's torso. I don't know.
What do you think that is? Yeah.
Man.
The home located in the exclusive Holmby Hills neighborhood was raided by Homeland Security earlier this year. He purchased the property back in 2014 for $39 million. This is 10 bedrooms where real weird stuff was happening and 13 bathrooms.
13 bathrooms, okay.
Yeah.
Wow.
Despite the arrest, shockingly remains on the market. 12 years? Do you think it's going to break MJ's record?
Is there well, maybe. They don't mention the dungeon.
No dungeon talk.
No dungeon talk. Okay.
No.
Right.
Imagine being that listing agent.
Yeah. Well, yeah. No, I won't go into it.
Oh, okay.
Yeah.
Fair enough.
As I said, I don't even know what's playing out. I just know the headlines, and I'm not reading any of the articles. You know what? I got to preserve my peace.
Yeah.
Yeah. There's just I have no interest. I really have. I mean, I have no interest.
He's still maintaining his innocence, by the way.
Yeah. Right.
For the record.
Yeah, okay. Yeah.
Well, there we go.
And so did Jeffrey Epstein.
Okay. With that, I think we're done. You all set?
I'm all set. Are you all set, bud?
Sure. Thanks so much for listening. Thanks so much for watching. We'll talk to you again next week.